Bring in Dan Primack now to talk more about this. If you think the IPOs have been tough, you should see what's going on with SPACs. Issuance plunging as the SEC also proposes a new set of rules to crack down on certain aspects of those deals. CNBC's post-SPAC deal trackers down 23% this year. Is the SPAC trend totally over, or could we see a resurgence? Let's bring in Dan Primack now. He's the business editor at Axios. Dan, overall, what does this mean for companies either hoping to do a traditional IPO, a SPAC, you name it? It feels like the door has slammed shut.
The door is definitely slammed shut. And a big part of that, I think, is on the buy side, right? If you're a hedge fund or you're a mutual fund that likes buying high growth tech stocks, why right now would you buy a new issue, whether it came via SPAC or whether it came via an IPO, when all those companies that Leslie was talking about that went public last year are mostly trading at pretty good discounts to where they went, if not where they went public, certainly where their highs were, by names that already have a couple quarters of public earnings under their belt.
Yeah. So if I'm a company that was counting on this exit process, what do I do now?
You wait. And for the private ones, not all of them, but for many of them, they raised enormous amounts of venture capital and private equity within the past 12 months. So long as they weren't kind of playing a little bit of a kind of venture arbitrage Ponzi scheme whereby, we're going to raise a bunch of money and then hire so many folks and it doesn't matter because we can raise again. So long as they were mildly conservative with their treasuries, they should have enough cash to get them through this.
Is the way the SEC is approaching SPACs now spelling the end of that method as a go public opportunity, or is it just a tweak and this will remain an option on the table for the foreseeable future?
I think it's a tweak. I think it's a depressive tweak. I think it'll definitely cut down on the number, but I don't think it ends it entirely. The big change that happens here relates, or at least the proposal, relates to forward-looking guidance. If you're a company going public via SPAC, you've been able to show or present data far in the future more than you could if you're a traditional IPO company. And so if you're a pre-commercial spaceship or flying cab company, that's been really helpful because you don't have any revenue this year, next year, the year after. This will equalize it. So I think we'll see some or fewer of those kind of more speculative companies come to market.
And SPAC has been kind of a scarlet letter for the companies who participated in the process. A lot of them are frustrated that they've kind of been tarred with this reputation now undeservedly being lumped together as, a subpar quality name. What would it take to rid that association of the SPAC process? A high-profile success story? What do you think?
Yeah, I think one or a couple. And what's been interesting to me about it is some of the bigger SPACs that we've seen over the past, 8 to 12 months that we thought were kind of the more solid companies have struggled in the stock market. You think Grab, you think Multiplan, these big companies that have gotten their butts kicked basically in the aftermarket. Yeah, I think we need to see a couple of these big ones succeed. And I also think the DWAC, the Digital World Acquisition, the Trump one, could be something that makes SPAC, that scarlet letter, even a little bit brighter as it's continuing to struggle in terms of actually getting its product to market.
Do you think that the SPAC investors, not the big guys, but the general retail shareholder base, do you think they're just left with a bad taste in their mouth, thinking this just isn't a great deal for them?
I think that's probably what it is. And by the way, it hasn't been. It's one thing if you pick and choose like any, trader, if you pick and choose and you pick well, good for you. And there have been some successful SPAC stories out there. But if you're buying these as some sort of bucket, let alone a quasi passive index, then you've gotten hit pretty hard.
Final comment, Dan, on the overall IPO market. A lot of these companies recruit, compensate, especially in a really tight labor market, around the promise of a big payday around that public listing. So what other options, either liquidity options or talent retention options, do they have?
So there's a couple things. If you're a privately held company and you do have cash and you have interested investors, you can always do a secondary sale in the private market. It's not going to be the same as saying to an employee, you're going to be able to sell all of your stock on day one or on, after 3 months. It's not the same. But you can help them take some shares off the table, help them pay the mortgage, pay off the car, et cetera. It's something we have seen companies do throughout kind of this bull market. And it makes sense if you've got the cash to do it, or maybe you've got an investor who wants, $5-10 million worth more of stock that you can do and you can help out employees.
Yeah, the sizzle is gone, but they still want the steak, I guess, if that's how the saying would go. Dan, good to have you. Thanks so much.